Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Ontario, Canada. My mission is to become the Google map for hardworking Canadians seeking financial freedom. Today we're going to go through the top 10 tax deductions for real estate investor. Before I get started, if you have not subscribed to our YouTube channel, make sure that you hit the subscribe button below or give us a thumbs up if you like the video. If you have any questions after watching this video, make sure that you comment below, ask the questions below, and I'll personally get back to you. Now let's get started. Today, we're going to talk about the top 10 tax deductions you should not miss as a real estate investor. Now let's get started with the first one. Number one is the general tax deduction rule. What it means is that the Income Tax Act in Canada allows you to deduct any expenses, all reasonable expenses that you incur for the purpose of earning business income or property income. So what it means is that as long as you would be able to establish the cause and effect relationship between incurring the expense and earning the income, you would be able to claim a deduction with certain exception. And we're going to go through some of the exceptions later on. Okay, let's use an example to explain. For example, if you're incurring mortgage expense for the purpose of earning rental income, there is a direct cause and effect relationship. Without the mortgage interest expense, you would not be able to earn the rental income. Or without the property tax expense, you would not be able to earn the income. That's where the cause and effect relationship comes in. Now, to earn the income, you have to also keep the receipts and documentation. What it means is that if you think that you have a remote chance of deducting, there is a remote chance for you to argue for the cause and effect relationship, you should always keep the documentation, keep the receipt. Without receipt, there is no way that you would be able to stand in court in front of CLA to claim your deduction. You need proof and documentation. That's the number one general tax deduction rule. Number two, going along with the same cause and effect relationship, there are a bunch of very straightforward deductions for real estate investor. This includes mortgage interest, the property tax, the utilities, insurance, your house insurance, your rental property insurance, the property management fees, and everything you think it helps to earn rental income within reasons. Now, these are all directly related to earning the particular rental income that you're earning, and therefore the deduction is totally allowed. And keep in mind, make sure that you keep the receipts for all these expense, mortgage interest. You would need to keep the annual mortgage statement, property tax, whether or not you pay by monthly installment or quarterly installment, you have to keep the property tax bill, annual property tax bill. Utilities, again, you have to keep all the utilities receipts on a monthly basis. Insurance, you have your annual insurance policy, you have to keep it to substantiate your claim. Property management fees that also has to be kept. The invoice would have to be kept, and anything that you can remotely think that there is a cause and effect relationship, make sure that you keep the documentation. Now, I also want to bring this up at this point that pure bank statement transactions as well as the Visa statement transaction themselves, they are not considered evidence to support your utilities claim or insurance claim or property management fees claim. You actually need to keep the actual invoice on its own to support your claim. Number three, you got to earn your deduction. I kept repeating myself and again. It's so important to keep all the receipts, and if the receipts faded and CLA would not be able to see it, it doesn't count. So it has to be a legible receipt that you keep. And CLA already allow us to keep all the receipts in soft copy, either in soft copy or hard copy. If you have a document filing system, either in paper format or in soft format, make sure that you keep a copy of those receipts, especially Home Depot or some of the music and entertainment expenses. They are printed on those glossy slip that could easily fade over a couple of years. So make sure you do keep legible copy of your receipts, whether in soft copy or hard copy format. The fourth deduction that people often miss is called finance charge. What's considered finance charge? Like for example, today if I go to Home Trust, which is a B lender, to borrow money, I often have to pay 1% lender fee I often have to pay my mortgage broker to help me set up the mortgage. It doesn't happen all the time, but sometimes it does happen, depending on what you are investing and how you're qualifying for financing. Another example that I have is we are in the process of purchasing our office space, and commercial lending often comes with financing charge as well. So when I apply for my mortgage for my commercial condo, BDC is asking for 0.5% of lender fee. So these are all the fees that are considered finance charge. Another example of finance charge is something called CMHC insurance, mortgage insurance. For real estate investors who are using more than who are borrowing more than 80% for their rental properties, you typically are required to purchase these mortgage insurance product from either CMHC or Genworth or another company that offers these mortgage insurance. When you pay a significant amount of premium at the time of closing, these insurance are being added to your mortgage amount. So you're not really paying it until you're paying it as part of your mortgage over 25 to 30 years. You're not paying it immediately. All these fees are considered finance charge, and you are eligible to deduct finance charge pretty much over 5 years. So let's say you incur a finance charge or you pay your mortgage broker a commission of $10,000. That could be amortized over 5 years as a deduction. Sometimes these finance charge is being paid at the time of closing as a one-time expense. Sometimes these finance charge, such as the CMHC insurance and mortgage insurance, they are being added to the mortgage amount, and you are repaying it over 25 years, 30 years during the term of your financing. And don't forget to pick it up at the closing document and amortize it over the next 5 years when you earn your rental income. The fifth deduction people often miss is called line of credit interest. A lot of real estate investors start investing by setting up a home equity line of credit against their primary residence because Toronto real estate has appreciated substantially. To tap into your appreciation, the appreciation of your home, you can set up a home equity line of credit with the bank. And once you set that up, you borrow against your home equity line of credit and use the fund for investment. Of course, because you're borrowing the money from the bank, you would incur the line of credit interest, and the interest expense is deductible against earning rental income. Now, the catch is that people often only have one line of credit against their home. And sometimes you would use the same home equity line of credit for both investment purpose as well as personal purpose. So as soon as you mix the usage of the line of credit interest, you have to prorate the amount of line of credit interest for deduction. Only the business use portion or the portion that's used for the purpose of earning investment income, rental income would be tax deductible. The portion that you incur for personal use purpose would not be tax deductible. Okay, number 6, auto mileage. So if you think about it, you drive your vehicle to manage your properties, and sometimes you do drive your vehicle to do repairs directly for your rental properties. And this is the reason why if you go back to the general deductibility rule that we mentioned earlier, you would also be able to deduct the auto expense that you incur for the purpose of managing your rental property. So therefore, you're allowed to deduct auto mileage or auto expense. Type of expense that you would be able to deduct that includes the following. Your gas receipts, you need to keep the gas receipts as well. Your gas expense, your insurance, your license and registration. I would even deduct the fine if there is any speeding fine. If you lease a car, part of the lease payment would be deductible. If you purchase a car, part of the purchase price could also be deductible. Now, the amount that could be deductible really depends on the business use of your vehicle. So in essence, you also need to keep a logbook in terms of how much you are using your vehicle for the purpose of running your business or earning the rental income in relation to how much you drive the car. So for example, let's say in 2021, you drove to St. Catharines or Hamilton. My properties are all in Hamilton and St. Catharines, just to take care of your properties, and you drove about 5,000 kilometers. back and forth the whole time. And through 2021, which is still a year of COVID, you rarely need to go out. So let's say 10,000 kilometer is the total kilometer driven on your car. So you have 5,000 driven for business purpose, 10,000 kilometer driven for all through the year. So basically, you would be eligible to deduct 50% of your lease payment, 50% of your gas receipts, 50% of your maintenance and repairs, 50% of your insurance license and registration. They are all deductible, but only up to 50%. So that would be how you would be able to deduct auto mileage or auto expense against your rental portfolio. Like, there are a couple of ways to keep track of the logbook. The first way to keep track of the logbook is by your phone. Easiest way to keep track of your auto log. You would be able to use an app called Mile IQ. By no means I'm endorsing them. I know a lot of my clients are using Mile IQ to keep track of their auto mileage. The downside of using it is that you have to log into the app regularly to make sure that you know which trip you are going, which trip is for business, and which trip is for personal use. So you do have to log in regularly. Now, the second app that I would recommend a lot of my clients are using already is the QuickBooks Online app. It has a built-in app to track the mileage as well. So if you don't want the hassle, you just want a sample auto logbook, you can always go back to my website in the link below, and we would be able to provide you with a sample logbook that you can use. The seventh type of expense is home office expense. If you don't have any external office and assigned designated office to run your rental portfolio, you are eligible to claim home office expense to deduct against your rental properties. Now, the challenge sometimes is that the judge does not agree necessarily with claiming home office expense. They sometimes don't think that you would need the space to manage the properties. That is one challenge. Regardless, there is an income tax folio that talks about deducting home office expense against earning rental income. For me, I would still maximize my deduction, claim it, document it, and if CRA ever comes back to me, I would always try to show them the income tax folio, and then we'll then decide whether we want to proceed with court case or not. But at this point, for my clients, I always recommend them to keep a bunch of documents to claim home office expense. And these includes, number one, all the expenses that you incur for your home. So we mentioned it earlier, all the expenses such as mortgage interest, insurance expense, property taxes, utilities, internet. I would always keep copies of all these receipts. And on top of that, you would also need to keep a copy of your floor plan. For example, if you have a designated office space, one room in the basement as your office, you want to keep the floor plan for all 3 floors to show that you're using that one room in the basement as your home office, as a designated area to manage your business. Now, how much can you claim as home office expense deduction as a real estate investor? Well, it goes back to your particular situation. It's typically based on the number of rooms or the square footage that you're using for managing your business. So using quick example, let's say you have a house and it's 1,000 square feet, and if you have a designated room which is about 100 square feet, you would then claim 10% of your mortgage interest, 10% of your utilities, 10% of your internet, 10% of basically majority of the expenses related to running your house as a deduction against your rental property. Just as a word of caution, when you claim home office expense, typically, if you only use your home primarily as your primary residence and there's only one room being used for managing your property, typically it would not affect your claim on primary residence exemption. However, if you are renting your property out and you have one room designated as your office as well, and you're claiming a bunch of other stuff, then that could potentially jeopardize your claim on primary residence exemption. It may mean that it may mean that you will have to pay capital gain tax. So when we do home office expense deduction, it really goes back to your particular situation. You may or may not be able to claim it, or we may not advise you to claim home office expense at all, not because you're not eligible to do it. It's just because if you're using your home office together with other use of your home, and it may actually jeopardize the possibility to claim the sale of your home as your primary residence. So we are trying to stay on the right side of CRA to make sure that we're doing the right thing. Okay, the eighth deduction is membership and education. So this is huge because there are a lot of real estate education or meetups or membership out there. And the truth is, a lot of people go through these educational program or membership events, and they learn a bunch of things, and then they go back to implement it. And if you apply the same general deductibility rule that I mentioned earlier, you could see the cause and effect relationship between incurring the membership cost or getting educated to earning the rental income. So to me, it sounds like it should be something that should be deductible against your earning rental income. So the problem of deducting membership and education expense is that sometimes the CRA auditor, does not look eye to eye with you regarding the cause and effect relationship, incurring the expense and earning the income. It's worse, especially worse for real estate investors who get educated and wait and wait and wait and wait before they take action. So sometimes some people, some of my clients would incur the expenses 2 years ago, but they don't take action until 2 years later. So in year one, when they incur the expense, I have nowhere to claim the expense. You're not earning any income, so there is nothing to deduct the expense against. Now in year three, when they start taking action, they're making maybe a couple $1,000 net rental income. It's not possible for the accountant to argue that there is a cause and effect relationship, and that's where the difficulty and challenge is coming in from. Now, if you are incurring membership or education expense, make sure you take actions, document why you are incurring the expense and how it helps you to earn the income. It's hard for your accountant to deduct the expense if you don't have the case to support you between the cause and effect relationship. The ninth deduction is called capital cost allowance. Now, I did previously set up a capital cost allowance video. If you want to click the link above, you can always watch that capital cost allowance explanation in that particular video. But for the purpose of rental deduction today, I wanted to mention that you would be able to claim a portion of the wear and tear on your house as capital cost allowance. If you purchase a house for $500,000, you can assign the whole thing as the capital cost, and CRA or the Income Tax Act allows you to claim about 4%, up to 4% of the building cost as capital cost allowance expense. Now, this capital cost allowance thing that we're claiming is only applicable if you have a net rental income. If you don't have net rental income, you are not allowed to claim it. The other rule about capital cost allowance is that if you are only allowed to claim capital cost allowance to reduce your net rental income to zero. You would not be able to claim capital cost allowance to create a loss. Now, another special thing about capital cost allowance is that capital cost allowance is kind of like RSP. So for those of you who are familiar with RSP, what it means is that similar to RSP, the year that you contribute to RSP, you don't pay the tax on the RSP contribution amount. So for capital cost allowance, it's similar. The year that you claim the capital cost allowance, you don't have to pay tax on the net rental income. Similar to RSP, the year that you withdraw from the RSP, you would have to report that RSP withdrawal amount as your income. Capital cost allowance, the year that you sell the property, the capital cost allowance that you've claimed over the years would have to be taken into income the year that you sell the property. So basically, capital cost allowance is not a tax deduction per se, but rather it is a tax deferral. It's a lot of the time it's still worthwhile to claim capital cost allowance, but it also goes back to how you use your property and what your plan is with the property. Okay, the last tax deduction is repairs and maintenance. Now, as all of you know, operating rental properties are not really passive. And a lot of the time you get late night phone calls about, I locked myself in the room, the toilet's not working, or there is a flood. So all these things happen. And if you have any repairs and maintenance on the property, you're eligible to deduct the repairs and maintenance under the general deductibility rule. Now, the reason why I mention repairs and maintenance and I call it out as a special deduction to mention in this video is because sometimes some of the repairs, CRA doesn't consider them as a repair expense. Sometimes they consider it as an improvement to the property and you have to add it to the cost of the building, and you can claim those as part of your capital cost allowance, not as a one-time expense. Now, why is it so important? Well, the reason why it's so important is because repairs expense is considered an expense deduction against your rental income. When it is being added to the cost of the building, when it is considered improvement, it's being added to the capital cost of your building. That is being claimed as capital cost allowance, which we mentioned before. It is a tax deferral, not a tax deduction. You have whatever you claim throughout the years would have to be brought back to income the year that you sell the property. So for anyone who is planning to do any renovation, you want to be able to argue it as repairs, not improvement to the property. And that's the reason why there is a significant difference between calling it repairs and versus doing improvement. Now, the second thing is so important is because these improvement that you made to the property is being added to the capital cost of the property, and it can be deducted against your future proceeds. But then the deduction, but then the capital gain that you earn on the property is only 50% taxable, and therefore all these capital improvement that you've made is only 50% deductible, whereas in the repair situation it's 100% deductible. And that's why naturally every taxpayer out there would want to argue the expense as repairs and maintenance instead of capital cost improvement. Now, what are the rules around deciding whether an expense is considered repairs or improvement? Well, just to give you an example, one quick example is that if you are replacing the old carpet with all hardwood floor, that is an improvement. That's black and white. That would have to be capitalized and being added to the cost of the building. Now, if you are replacing the black shingle roof with a metal roof, that is also an upgrade, and an upgrade is also considered capital improvement, and therefore the metal roof replacement cost would have to be added to the cost of the building, and it would be claimed as part of capital cost allowance and eventually ultimately being claimed against the sale price of your property. Now, sometimes it's not black and white because whatever we do to the property, in a way, it could be considered as an improvement. CRA does have two rules as well to help us to isolate those situations that has to be recorded. The expenses would have to be recorded as capital costs. One of the examples is that if you purchase an old house and all the expenses that you incur for the purpose to get the house ready for rent, that expense, whether or not it is as small as painting the house or replacing the light bulb, those expenses should be capitalized as part of the capital cost because you know what you're buying and you're really just getting the house ready for rent. And that period of expenses, all that repairs are always considered capital cost. Another example is that if you are getting the house ready for sale, you are incurring the expense for the purpose of selling the property, then those expenses that you incur for the purpose of selling the property, whether or not you are painting, refreshing the whole house to get it ready for sale, cleaning the house to get it for sale, or repairing the deck, repairing the hardwood floor, all these expenses that you incur for the purpose of getting the house ready for sale is also considered capitalized improvement, and it has to be added to the cost of the building and deducted as such. So these are two exceptions. Now, so one of the most commonly asked question is that, like, what about I set up a legal basement suite? Is that considered repairs or capital improvement? Typically, if you spend hundreds of thousands of dollars, you would have to add it to the cost of the building and claim it as capital cost improvement because there was no legal secondary suite in the past, and now you're putting one in, so that is capital improvement. Now, what are the tips of in terms of repair, spending money on repairs? Well, one thing that you can pay attention to is that the timing of the expense. If you know that you have to replace the roof, say when you purchase the property, maybe don't replace the roof if you can drag it out for a year until you tenanted the property, have tenants living there for a while, and then you replace the roof. Typically, the roof doesn't really come down the moment that you purchase it. That's when you get to play around with timing and maximize your tax deduction. So now that we've gone through the top 10 tax deductions for a real estate investor, if you have any questions, make sure that you comment below, and make sure that you also subscribe to our YouTube channel so then you can stay on top of the latest tax tips. And if you like the video, make sure you give us a thumbs up or share that with your friends so then YouTube would be able to share that information to more people. Until next time, thank you so much for watching.